All right, well, we're going to take advantage that everyone's here a little early. So we will start. So thank you, everyone. Good afternoon. And thanks for coming to the launch of the World Economic Situation and Prospects Report as of mid-2024. We have today with us Mr. Shantanu Mukherjee, who is DESA's Director of Economic Analysis and Policy. And we also have with us today Mr. Hamid Rashid, who is DESA's Chief of the Global Economic Monitoring Branch in the Economic Analysis and Policy Division. And they're here to present the report, which I'm sure is really interesting, and I see that you already have some copies. They'll do some introductory remarks, show you a short presentation, and then we'll have some time for Q&A. Mr. Mukherjee, please, you have the floor.
Thank you, Florencia. It's a pleasure to meet everybody here again to present some of the key findings from our mid-year update. The main report was launched in January 24. In this year's update, we have a small section on critical minerals, which will be developed further in the final report that will come out in 2025. And we also have a SIDS fact sheet, which has been developed for the SIDS 4 conference. And if you visit our website, you'll find our data to be downloadable. So Hamid will make a more detailed presentation, but I'd just like to flag 3 topics that we think are important. First, of course, is overall performance and prospects. And here, for the world as a whole, our prognosis is one of guarded optimism, but with important caveats. So for 2024, our global growth forecast is now estimated to be 2.7%, which is up from the 2.4% we were expecting in January. And for 2025, we are expecting 2.8%, also up a little bit from what we were thinking earlier. And these changes are actually coming from better than expected performance in some of the large developed and emerging economies. Inflation, which has dogged us for a while, is down from 2023 peak in some countries, but I'll get back to this in a bit. And in developed countries, tight labor markets are seeing wage increases for some parts of the population, also drawing people into the labor force, which is important. Now, on the other hand, the outlook for many developing countries is not as rosy. So even when there are improvements, for example, with SIDS, prospects for 24 and 25 are being revised upward by us to about 3.3% growth each year. It still remains much below the pre-pandemic average. So lost ground is still not being made up. And importantly for Africa and LDCs in general, prospects are revised downward to about 3.3% growth in 2024. This is particularly worrying because Africa is home to about 430 million living in extreme poverty and close to 40% share of the global undernourished population. 2/3 of the high inflation countries listed in our update are also in Africa. So as you know, SDG 1 and 2 are going to be in focus at this year's high-level political forum, and we think a lot of the discussion there will be germane to this situation. At the same time, cause for concern is that African governments' room to maneuver is also shrinking. In 2024, over a quarter of public revenues on average in this continent went towards interest payments. That's, again, about 10 percentage points more than the average over the years immediately preceding the pandemic. Now, for developing countries on average, the debt situation is not as dire, but an important cause of concern, which we've been flagging for a while, is that investment growth continues to fall. Perhaps even slightly sharper decline, according to the latest figures. Now, compounding and sort of contributing to these downsides are some notable risks. Hamid will be mentioning some of these. But I will just like to mention inflation, because it's both a symptom of the underlying fragility, but also a cause for concern in its own right. On the one hand, inflationary pressures are still lurking in the global economy. We've seen that some countries, inflation continues to be high. Globally, energy and food prices are inching upward in recent months. But I think a bit more insidious even is the persistence of inflation above the 2% central bank target in many developed countries. Now, inflation in these countries has fallen sharply by almost 2/3 from its peak in the US, for example. It's sticky. And expectations for the interest rates to fall gradually keep getting pushed back, and these higher for longer interest rates are extracting a toll in terms of higher costs of borrowing, but also higher risks to debt sustainability in countries that are least equipped to respond to them. Of course, it's not just developing countries that feel this toll. Developed countries too have to contend with these rates depressing investment and increasing potential risks to specific financial institutions, for example. So this is indeed a space we are watching with great care. Now, finally, to the special section in this report, you know that every year we address a special topic. This year we have picked up critical minerals. Countries have different criteria for this, but minerals, ores such as related to lithium extraction, nickel, cobalt, copper, and the rare earths are present in most lists, and a valuable introduction to the periodic table for someone like me who hasn't seen it in a while. So in our report, we are focusing on those that are essential for the energy transition. Now, over the last 5 years, the market size for critical minerals has doubled, with that for lithium, for example, growing about 7 times. And there is some uncertainty about the specifics of how this will continue in the future for particular minerals. But there is consensus that this market will continue to expand. So in our report, we have introduced and we are exploring 2 intertwined issues which we think are important. The first is how to encourage the production and availability of critical minerals at the scale and speed that is needed for the energy transition. And the second is, how can those countries that are rich in these resources leverage these to turn into long-term SDG gains? The second question, we think, ties into the HLPF session this year in particular, but is also particularly important because when growth overall is kind of low, this is an area where there is potential to deliver greater gains. So we look in our report at ways in which these resources can be turned into a blessing, and we can avoid what is often known as the resource curse, when these resources don't turn out to be as beneficial as they might have been. Policies, of course, depend on country circumstances, but we are looking for ways to maximize economic, social, and environmental returns to the country as well as to local communities. International cooperation that could support investments, technology transfer, improving the regulatory and implementation capacity, combating illicit financial flows would all be essential. As you know, the Secretary General has recently announced a panel to address many of these issues, and we think that this panel will be extremely important in laying out the way forward for international cooperation and national action. I'll now hand over to Hamid for a more in-depth look. Thank you.
Thank you, Shantanu. Good afternoon, colleagues. So I'll try my best not to repeat what has already been said, but overall global growth outlook has improved modestly, we can say, and this is exactly, although we call it a mid-year update, but it's actually an update from the last quarter that we had in December, and we have the full quarter data of the first quarter of the year. And that gives us a mixed picture and calls for cautious optimism here. And as has been said already, that we see some improvements, mostly driven by few large economies. Namely, the United States have outperformed expectations. Also, we saw very robust growth performance in India, also in Brazil, and some other large developing economies, also including some improvements in the European Union as well. Very modest improvements. But offsetting that gains or improvements, we see significant or some deterioration in growth outlook especially for Africa. We monitor Africa, 5 regions in Africa. 4 out of 5 regions have seen some deterioration. Except for East Africa, we see everywhere some growth deterioration since our last report. Also, not surprisingly, we see the growth outlook deteriorating for West Asia, given the geopolitical conflicts. We have seen that. But overall, this mixed picture, there are more downside risks to this outlook than upsides, and those risks are mainly threefold, and this is our baseline scenario. Of course, almost every economic activity is affected by higher than longer interest rate expectations, and this is driving investment decisions affecting growth outlook. And we have, for the developing countries, we see debt challenges to be far more significant than in previous years in terms of squeezing fiscal space in many developing countries. And then, and we see the geopolitical risks also becoming more and more pronounced as we approach the second half of the year. So, as I said, most of the growth, positive outlook within the developing economies is driven by South Asia and East Asian economies. India has done remarkably well. We see quite a bit of improvement from the growth outlook for India. 6.9% this year and 6.6% next year. So that is looking good at this point. As I said before, Western Asian countries are facing some challenges. Inflation has declined worldwide, but in some major economies, it still remains a concern. Namely, the United States. We saw that inflation numbers came out yesterday for consumer price inflation, which is not the main policy inflation that Federal Reserve targets, but that inflation has moderated slightly compared to last few months, which is a good sign. But the inflation that the Fed follows very closely is the PCE inflation, personal consumption expenditure inflation. That has remained still above the target, about the 2% target. I think it's 2.7% that came out last month. Labor markets in the developed economies remain very tight, which is putting some upward pressure on wages, and unemployment is historically low in many economies. But developing countries' labor market, we can't say a lot of changes happened in the last 4 months because it is the same structural challenges that we see persisting in those economies. Informality is big. Gender disparities are quite significant in the employment, and also youth unemployment remains a major challenge. So we see some improvement in global trade, again, driven by certain group of countries. Not all countries are seeing that trade momentum, and especially East Asian and Southeast Asian economies that are manufacturing dependent, or they are seeing some improvements. But trade also faces significant headwinds, especially because of geopolitical risks, especially in the Red Sea. We saw some escalation of tensions there, leading to higher freight prices that affects the global trade flows. It is important to note that trade still remains way below the pre-pandemic level of trade growth globally. And trade used to be the engine of global growth, especially for the developing countries. And we are not seeing that engine restarting. Still, there is a lot of downward pressure on global trade. Investment, as has been said, Shantanu said, that investment remains weak in most countries, even trending downward in some places. We can comfortably say the monetary tightening phase is probably over at this stage, but monetary easing hasn't begun yet. So we're in a limbo right now. So most countries have pretty much maintained their monetary policy stance at the beginning of the year. There's been no major shifts. But a lot of countries are waiting for the lead from the Federal Reserve and ECB. And if there's a change in position, especially the Federal Reserve, if they introduce the first rate cuts during the second half of this year, other countries would likely follow. But at this point, we see a wait-and-see mode. So, as I said, the fiscal space in developing countries remains severely constrained. If you look at Africa, I think it partly explains that why growth in Africa is actually deteriorating outlook, because one of the main drivers of economic growth for many developing countries are public sector spending. And public sector spending right now is mostly going into servicing their debt, which doesn't produce a lot of GDP. So average for Africa is about over 27%. There's $1 out of $4 is going into servicing debt, public debt. I think that's a huge burden on Africa's growth prospect, and that is a challenge for many reasons, including the reason for this is Africa's goal for achieving the SDGs, so that would be severely affected. Some conflicts continue to be a major drag on growth. Also, that is leading to higher defense spending in many countries. So our thematic focus for this mid-year update leading to the final report in January next year, we're focusing on the critical minerals, which was not on the radar screen about 3 years ago, but now almost every news article, newspaper, you'd have every day some report on critical minerals. The demand and supply, the ambition that we have for net zero transition is not met with by the supply side. You see in these graphs that copper actually production is declining when we need far more copper to achieve net zero goals. Cobalt, I think we need 2.5 times more cobalt in the next 6 years or so. Same with lithium, 2.5 times more, but supply is not keeping up with the anticipated demand. And that is creating a lot of challenges in the critical minerals market. And also the challenges are compounded by these minerals are highly concentrated, both in upstream, meaning mining activities, and also midstream activities where the processing takes place. The ore that we get from lithium is not battery grade. So in order to make it battery grade, you need a lot of processing, and that is also very concentrated. So we see some silver lining there in terms of that could be a potential driver for not only for driving energy transition, but also some growth opportunities for some of the countries in Africa and Latin America. We see many countries are now deploying industrial policy and other kind of policies in place to support their extraction and of critical minerals and have more local value added. But you see a lot of the policies that we're seeing right now are taken in advanced economies, and developing countries also trying to do the same in terms of having innovation policies in place, industrial policies in place to drive and to maximize the benefits of those critical minerals. So the last slide here is that what we see as a potential driver for growth in the near term for many countries that are endowed with critical minerals, but that would not come automatically. We would need a lot of national policy support and focus. We need countries, especially developing countries that are trying to enter that market, they would have to think about more horizontal and vertical integration of the production, not just be a source for raw materials. It's very easy to extract and export, but many countries are now trying to move up the value chain and have more midstream activities. And that is linked to the idea that Shantanu mentioned, is that countries will need to learn from the past mistakes. Resource scarce effect in many countries in Africa where that had rich endowment of natural resources, but they didn't benefit from those resources. We want to make sure, see that doesn't repeat, that mistake, countries don't repeat the same mistake. This time they're able to address some of those concerns that they had in the past and able to have more local value addition and sometimes called localization of some of the processes. And also, they need to be complemented with strong international support, especially mining and mineral extraction is now extremely technology-driven. So technology transfer is very important. Financing is very important because without financing, you can't open a mine, and there's a huge lag period. From the day when a deposit is discovered versus when actual production happens, there's a huge lag of 5, 7, 10 years, and there's a lot of long-term investment is needed in those sectors. And market access will be very important because, as I said, the concentration is very high for among certain categories of minerals, and we need to have more market access for the developing countries. And all of this would require more capacity building in the developing countries as well. Thank you.
Great. Thank you so much. Now we will turn it over to questions. Yes, Amélie.
Thanks. Amélie Bottelier from AFP News Agency. I have a specific question on seeds. You mentioned their situation, and there's the seeds conference in 10 days in Antigua. I was wondering, you talked about the next few months, the next 2 years, but we know that these countries are some of the most vulnerable to the impact of climate change. So how do you factor in this likely impact on their future development, not only in the next year, but in the next 10 years as they will discuss their plan for the next 10 years? Thank you.
Okay, I think we are in the business of relatively short-term forecasts. I'm just being modest and upfront over here. And part of the reason is, as you said, there are long-term threats about whose impact we kind of know on the average, but in a particular year, what will happen remains a little bit uncertain. So we do include some expectations in the way we do our short-term modeling. But I think for the longer term, we have to look at what SIDS can do to establish greater resilience, given that climate change is obviously here and real. And some of the prescriptions we have seen have to deal with greater diversification of the economies, so that if one sector is hit, other sectors can be protected. We find that for many SIDS, remittances are an important source of growth and support. And remittances clearly are coming from outside SIDS. So these can help SIDS as they're growing forward. In certain areas where there is good control over the blue economy or the resources that are available in the ocean around them, these are also good for establishing support. But, I think what we're seeing in terms of our expectation that there is an increase in growth of SIDS is also a little bit cause for concern, because that increase is coming mainly from tourism. And that is again telling us that these economies are not sufficiently diversified. We would like the economies to be more diversified, to be able to connect better to some of the new value chain, value addition products that will be created for export markets.
Yeah, thank you, Shantanu. I think I would add one point to that. There's a lot of heterogeneity among the SIDS as well. If you look at the Pacific SIDS versus the Caribbean SIDS, the level of debt, domestic and external debt, is very different. And debt level is also a major concern for some of especially the Caribbean SIDS, high level of debt. And you see that among the vulnerable group of countries, the LDCs and SIDS. SIDS are actually performing relative to LDCs and LDCs, their performance growth outlook is weaker. And that is partly driven by also their vulnerability, not only from climate shocks or climate risks, but also from other macroeconomic risks, including excessive dependence on remittances and tourism, and then external debt. That is a major challenge for some of the SIDS.
Okay, thank you. We'll go to Ibtisam and then Yvonne.
Thank you. My name is Ibtisam Azim, Al Arabi Al Jadid newspaper. I have two questions. The first one regarding the Federal Reserve here in the US and the fact that they are, or do you believe that they are too slow in implementing rate cuts? And if I'm not mistaken, and please correct me if my memory doesn't fail me, I think last year when you talked about the target of 2% of inflation, I believe, if I'm not mistaken, you said that maybe the 2% is no longer applicable, and maybe it's better that countries have a flexible approach of 2.5% to 3%. Is this still the case, and why things are not moving in this direction? And the second question is regarding conflict zones, especially in the Middle East, the war in Gaza. How do you see this influence not only the Palestinian economy, but also economies of neighboring countries? Thank you.
Just start this, but I think there's a lot of information in our report as well, and Hamid can fill in. Well, first is the Fed moving too slowly. I think the Fed is doing what's right for the Fed. And I think we've seen that it's very important to manage the expectations of different private sector and other players as to what the inflation is going to look like. And once the target has been set, it's difficult for the Fed to do things that may go against those expectations. We've had some instances in the past where such action turned out to be detrimental to the overall sort of goal of maintaining stability in the Fed. Having said that, certainly there are spillover effects. But the 2% rate is not universal across countries. Countries choose what the optimal inflation rate would be. And even in the US, it is an average to be maintained over time. I think the Fed is wary, given that the labor market is so tight, consumer expenditure is quite high, that any signal it might give about a greater access to credit might spur a burst in inflation once again, which would be detrimental in the longer term. I think that's what's driving some of the Fed's reasoning right here.
Your memory serves you right for sure, because this is what position that we sort of explained in our previous edition of WESP, that there's some degree of orthodoxy in terms of inflation target and 2%, and even economists from all stripes and are questioning whether that 2% target is the right target for Fed. But that's a different question for us, because we in WESP, we don't try to take a normative position unless it's absolutely necessary. We try to explain things the way they are. And we see that Fed would continue to pursue this 2% target regardless of the spillover effects, not only on the US economy, but on the rest of the world economy. Because when the Fed maintains a tight monetary policy stance, it has a huge cost for the rest of the world. And that's the argument that we made in our previous edition of WESP, that Fed is a central bank of one country, and they have to prioritize their own national economic interests, including managing expectations that Shantanu mentioned. But overall, there are a lot of costs on both sides in terms of inflation that I mentioned, that CPI inflation number came out yesterday, but Fed looks at not the CPI inflation. CPI inflation is about how much you pay to buy things, and PCE inflation is about how much you basically consume. That what you consume is not necessarily what you buy. Sometimes you buy something but you don't consume, and sometimes you consume but you don't buy. Rental, for example, or one of the most interesting calculation for Fed is that owner imputed rent. And that is 1/3 of the PCE inflation. And a lot of argument has been made right now. That part of inflation is very sticky and very slow moving. In fact, it captures data from about 6 months ago. So Fed, in that sense, probably can target some other matrices to see whether PCE should be adopted or revised a little bit. But overall, Fed is going to stay on course in terms of managing expectations. Even at the more recent discussions within the Fed and outside the Fed is that even Fed would not hesitate if they need to raise interest rates. And that is probably a very tail scenario. It's not a very high likelihood, but Fed, given the stickiness of the inflation that they're seeing, and is persistent, Fed may even try to raise one increase. Is not completely out of the possibility.
If I can just add one point, and we'll get back to the Gaza question in a bit. I think what's of sort of, while the game is on, you don't change the rules. So I think even if the Fed were to think hypothetically that it makes sense to change the inflation target, it wouldn't be until it's achieved this 2%. But I think what's of general concern to a lot of economists is that there are various forces operating in the background which may be working to push inflation up. And so then, for example, we've spoken about climate change and how climate change disasters can actually suddenly curtail the supply of food. Or there are conflicts which disrupt supply lines or raise shipping costs. All of these things are pressures in the rest of the world that could raise inflation through supply side impacts. And so then the question becomes, is monetary policy really the right instrument to try and tame inflation on these sides? So it's a trade-off here. We have to think a little bit more carefully about these things.
Okay, and then on the Gaza question?
The conflict in the Middle East, of course, is having a toll in the region and also beyond. So far, one probably silver lining, the oil price has remained stable. And if the oil price takes a different direction in terms of a big oil price shock, that would affect economic growth, not only for the region, but also outside the region. But again, there are winners and losers. Even in every scenario, if higher oil price would probably benefit some of the oil exporting economies within the region, but it would overall hurt the global economic recovery or the growth that we see right now. Our baseline forecast right now based on an assumption that oil price would remain about $72 per barrel. And that is critical because that may change. If oil price goes to $100, the growth outlook would be very, very different. But so far, we are seeing that the conflict has remained contained within the region, and it hasn't had a huge spillover in terms of affecting the oil prices. And other, definitely the unknown or a contributing factor is the disruption in the trade routes. If there is further escalation of conflicts in the region, and if the key trade routes are affected by that, both in the Strait of Hormuz and also in Red Sea, that can have a huge knock-on effect on the global economy.
Okay, we'll go to Yvonne and then Stefano.
Thank you. Yvonne Moriarty News, the Irish national broadcaster. So I have a couple of quick questions. You said mining and extraction are highly geographically concentrated. Can you just explain a little bit where those geographic concentrations are and in what sector of the mining and extraction field? And my second question is, you've written here international cooperation is a must for developing countries. But given the geopolitical divide that we see on a daily basis here at the UN, how do you assess the chances of the international community coming together to tackle this particular area? And then lastly, on the resource curse that you mentioned, it's been an issue for since time immemorial. What's going to be different this time, and how can the UN ensure that it is different this time for African countries? Thanks.
Yeah. Thank you. I think the resource concentration, you have to ask what resource we are talking about. There are about 50 of them that are listed as critical minerals, but 5 or 6 are more critical than others. They're not all equal. So if you take lithium, which is, everyone talks about lithium, this lithium-ion battery is the main driver of energy transition. So lithium production, raw lithium, is concentrated in 2 countries, basically, Australia and Chile. They account for vast majority of lithium, raw lithium or spodumene. And then you have a lithium triangle in Latin America, which are coming to the pipeline, Brazil, Paraguay, and Bolivia, and Argentina. So that's maybe it's not a triangle, but quadrangle. So these are the countries that are major suppliers of lithium. When it comes to processing, it's mostly concentrated in China. And China plays a very important role because China had taken a very lead role in terms of anticipating the future in terms of the demand for this energy transition, and given that they didn't have enough oil, made them think about, okay, what are the alternatives? So China has a huge, plays a very important role in terms of processing of the critical minerals, not just lithium, also in cobalt and nickel and other critical minerals that are collectively known as the battery materials. So that is where you see the concentration. In terms of avoiding the resource curse, this is obviously, I would not touch on the international cooperation side. I think Shantanu may comment on that. But on avoiding resource curse is actually something that we believe that this round, the term that was used in the past, industrial policy, is getting a new shape, a new form in this round. Countries are seeing industrial policy as driving not just economic growth, but also make growth more sustainable, more equitable, and more resilient. So there's a transition about not just having, export-led growth or more value addition, but they're thinking about how would that create job. And there are a lot of good practices coming into play. For example, there's a corridor between, Congo and Zambia. One has cobalt, one has copper, and they're trying to build a corridor in terms of taking advantage of the value addition in the continent. So I think the good news is that countries have learned from the past mistakes, and it's possible with some enabling conditions that countries can do better this time in terms of taking advantage of the resources that they are endowed with. So we see a more sort of positive outlook there, but that would also be driven by global cooperation and global market access issues as well. So.
Thanks, Amit. I just want to say that, the resource curse is not inevitable. And we have good examples. Botswana comes to mind. So does Malaysia, which have actually turned these growth opportunities into stable pathways to development, and not just economic development, but also development of societies and people. I think, as Hamid was saying, a lot has also been learned, and I think a good place for international actors is actually to make sure that the capacity to implement some of these lessons is there. For example, now there's much better understanding of how to manage the volatility of revenues that comes with this, because all of these commodity prices go up and down. And so when the price is high, you're earning a lot, and then when it crashes, you're earning nothing. So this used to be an important part of what used to contribute to the resource curse earlier. But now it's not inevitable. You have countries like Timor-Leste and others which have set up ways to stabilize these inflows. But this lesson and the capacity of how to implement it is an important part for international agencies to take forward. Another important part on this international cooperation area would be to agree on common guidelines. And these could be voluntary guidelines. They don't have to be, punitive ones, but common guidelines on how the social and environmental costs of these extractions would be managed. And if there's agreement on these guidelines, we've seen them to be quite powerful, for example, when we think of labor-related issues in production, right, and export-related. So we want to avoid scenarios where there's a race to the bottom in terms of safeguarding the environment, in terms of safeguarding social aspects. In return, perhaps, for the right kind of investment support for multilateral development banks. These could be powerful ways in which international cooperation can play out. And I think these agreements, because there is by and large agreement that these resources are essential for the green transition, and there's great momentum for the green transition too. So these could be driving forces around which people could come together and actually work out ways in which to be pragmatic, but also accelerate this change that we're all hopeful for. Another one, which one of my colleagues mentioned the other day, is that how do we curb illicit financial flows? This is going on, these discussions are going on in different parts of the multilateral system, but this illicit financial flows used to be a big element of how rents from these resources would be siphoned off outside the country. But if we are having a framework agreement on curbing illicit financial flows, certainly this would feature there as well. Thank you.
Okay, Stefano, please.
Thank you very much. Stefano Baccara, La Voce di New York, Ital Press. If I read well this chart, it looks like you are always very close in your GDP estimation, but the one that you missed the most, looks like, is Russian Federation. So, question is just because happened, or because you thought that actually what's going on with the war things should have been, I mean, this data that you give, that doesn't make sense maybe with what you expected. Also, there is another one interesting, that he's in Africa, East Africa. With everything going on in East Africa, we have the basically, we have a 5.6 and then 6.1. There is basically India is like growing like India. So can you explain this? Looks like when there is war, there is growth.
Not that we are welcoming war of any kind, but I think you raise a very valid point in terms of, so this is our cutoff date of mid-April, the numbers that you're seeing. Actually, the numbers that came out after April is even more optimistic about Russian Federation. So two factors explain why growth numbers are significantly higher. One is that Russian Federation economy is right now in a full war economy mode. So you see a lot of public sector spending, and that is giving a lot of GDP. But as we know with the history of wars, like that is a sort of short-term growth spurt, and it will not be sustained. So you see a sharp increase in growth, and overall, that doesn't last for too long. When you would draw that kind of stimulus for war, that growth would come back to the trend growth rate that we expect. That's one factor. Second factor is, of course, Russian Federation economy has faced significant amount of sanctions, But those effectiveness of those sanctions, again, we are not taking any position on this issue, but there are ways that economy didn't suffer the consequences that it was supposed to suffer. The trade relationship, exports from Russia actually increased to certain countries, and that has benefited. And growth projections that we made had to be revised upward. If you come to me in July, the numbers will be different again. So it's a catching up game to some extent. But what we see is that these growth numbers that are very short-lived spikes in growth, but that would not be sustained over long term. East Africa, again, some bright spots in East Africa, especially Kenya, has done relatively well compared to the region. And you are looking at benchmarks in other parts of Africa, which are really affected by Sahel region, West Africa, or Southern Africa. Energy shortages and all these factors are affecting other regions on Africa. So East Africa, relatively bright spot, Rwanda, Kenya, Tanzania, so you see growth. And part of the growth is also driven by Ethiopia's historically high growth rates. And Ethiopia, on average, grows at 7-8%. I don't have the exact number for Ethiopia right now, but that's also driven by that. So that region is relatively outperforms other parts of Africa historically, especially given the high growth performance of Ethiopia and Kenya.
I think it's also important for us to just take a moment to recognize that GDP is basically, it's a measure of aggregate economic activity, and it's agnostic about what's driving that activity. And so military expenditure, defense spending, these are all expenditures that don't advance human progress necessarily, but they will show up in GDP. So when we also talk about Ukraine and we say that its GDP growth rate is up by 5%, is that cause for celebration? Not really, because in the previous year it was down by 30%. A third of the economy is wiped out. So I think these numbers have to be seen in the right context. And with GDP, it's extremely important to also recognize what's being left out. And that's a discussion that happens in other places. Sometimes we forget it. Because GDP is important, we talk a lot about it. But we also have to recognize what it's not telling us.
Yes, please.
I've had a short question. My name is Volodymyrchenko, National News Agency of Ukraine, of Reform. About your terminology. You again write in your report about the war in Ukraine as something abstract, as if it is being waged on its own. Why don't you write Russia's war against Ukraine? After all, there is no internal war in Ukraine.
Language.
We are probably not good in linguistics. We are economists. So I don't think we are giving and attributing any value of any kind. But this is, again, I wrote in the past about the Russian Federation's invasion of Ukraine, and many other terms have been used. So this is a very short report. We want to be economical with the words, and we have a very strict word count. So we don't go into the narrative about the causes of the war and what was driving what. So here we just wanted to give the minimalistic picture of what is the economic impact of that war. Thank you.
Thank you. And I think if you have time for one last question, I think we have one online from Arul. Arul, are you there? Okay, I don't think we... No. Okay, one last one from Evelyn. Quick one. Oh, Arul, we can hear you. Go ahead. Yeah, go ahead.
Yeah. I've got a couple of questions. One is that what are the factors behind raising India's projected growth rate by 0.7%? Second, what are the downsides you see to that? And finally, there seems to be a trend towards deglobalization by increase in protectionism. How do you think that will impact the overall global situation and going forward? Thank you.
Okay, and I'm going to take Evelyn's as well so we can wrap it up because I know you guys have to go. Evelyn, please.
Evelyn Leopold, Globetrotter Media. The stock and bond market is very high right now in the United States. Does this help anybody but developed countries? And secondly, in the Sahel and West Africa, Russia is very active there. Is it improving the economy, or can't you tell yet?
All right, you can choose where you want to start.
So on Indian economic outlook, I think the drivers are very simple. Indian inflation has come down significantly, and that means that the fiscal position is not as constrained as in other countries. And there's both support on the monetary side and the fiscal side in terms of stimulating growth. And already that growth momentum actually was from last year and is continuing, and also India's export has been pretty robust. So I think, given all these factors, I think this improvement is a very reasonable, modest upward revision that we have done, given that what we see is happening in the Indian economy right now. And India is also benefiting from more investments coming into India from other Western sources, as less and less foreign investment is going into China, Western investment is going to China. India has become an alternative investment source or destination for many Western companies. So I think that is also benefiting India. And finally, that oil price and a special import arrangements that India has with the Russian Federation, that is also helping India tremendously in terms of keeping its import costs down. So overall, I think we are very comfortable with the numbers that we have for India, and there might be some revisions going forward depending on how the rest of the year plays out. We haven't done any work on e-commerce. I think that was the question, right? Or e-globalization?
Deglobalization.
Deglobalization, okay. So I'm sorry. I think this is a much bigger discussion. Probably we don't want to keep people hungry at this stage. It's lunchtime. But it's a very long conversation. This is a trend that began even before the pandemic. Pandemic became a major break in the global trends, and we see post-pandemic, we don't see a reversal of the deglobalization trend that began, at certain time before the pandemic. So I think your observation is right in terms of we are seeing a more entrenched deglobalization, and that's why we see global trade is taking a hit. But hopefully, and again, it's some optimism there that some of the issues that may bring countries together, including the issues of critical minerals, and hopefully that would create new opportunities for cooperation and at least slow down the process of deglobalization at this stage.
I think, this, like Hamid said, deglobalization, we could probably have a whole report on it. But we should be also careful to not see these big changes in isolation. Technology is completely upending how goods are produced, services are traded. And we see for some time that merchandise trade is slumping, but services trade is going up. So I think we have to look at the picture in a more integrated way instead of isolating just one element and looking at it very narrowly, because there are many things going on at the same time, and we have to make sure we have the complete picture. As to what's happening in the Sahel, our forecasts are actually showing that West Africa is not doing well. And we have also had some concerns about the withdrawal from ECOWAS of several of these countries, which we have mentioned in the report, and how it affects the trading agreements. Whether this is due to activities of Russia or any one country versus the other, I don't think we can actually say. There's a good economic reason for saying we can't say, not just a political one, which is that it's hard to assess what would have happened if something like a particular intervention had not taken place. It becomes hard to figure that part out. Thank you.
And I think finally the stocks and bonds question.
Which was, if you don't mind repeating that one.
Yeah.
Was it that stocks and bonds are doing well in the US? Does it have an effect on the rest of the world? Yeah?
Yeah, it depends. If you're holding stocks and bonds, of course, it's a good news for you. But if most of the developing countries don't have a lot of stocks and bonds traded in the U.S. market. So in general, of course, you see one of the striking trends in the U.S. and actually in most of the developed economies is that rising income and wealth inequality. And that sort of mirrors what we see in the stock market, because we see even any kind of shock, stock prices go up, don't go down. So there's a disconnect. We wrote about it in our previous WESP, that disconnect between the financial sector and the real economy, and that is continuing as well. So,
One small way in which this connects to what we were saying earlier is that if the US bonds are giving high returns and people are holding them preferentially, this creates problems for developing countries in the longer term.
Okay, well, I think that was really interesting. Thank you very much. As you can see, a lot of different and diverse questions. Thank you so much.